All right, so we're going to go ahead and get started. So, thank you everyone for joining us today. Welcome to another event with Let's Move by United Healthcare, where we aim to keep you engaged in healthy, fun activities to help you maintain a healthy lifestyle. You can keep up with what we have going on by visiting letsmovebyuhc.com. That's letsmovebyuhc.com and logging in with your United Healthcare username and password to see upcoming events, educational information, and more. You can also access that site by logging into your United Healthcare member portal, clicking on the Health and Wellness tab and the blue ribbon across the top of the page, and clicking on the Let's Move button on the Health and Wellness page. So as part of helping you maintain a healthy lifestyle, we work to engage you in events around physical activity, nutrition, mental health, and more. And this includes stress management. Elevated levels of stress can make it hard for us to have the energy to be physically active, can negatively affect our appetite, disrupt our sleep, and exacerbate other health conditions such as depression, anxiety, high blood pressure, and diabetes. One of the top stressors year after year, according to the American Psychological Association's Stress in America survey, is money. So, along with other areas of wellness previously mentioned, we've been working to provide you with information on financial wellness. And with that, today we have with us certified financial planner Mac Gardner. Matt Gardner has spent over 20 years in the financial services industry. He wrote Motivate Your Money to provide helpful insights, education, and guidance along your financial life journey. Mac is an award winning financial advisor. He is recognized by the industry for his work promoting financial education and financial wellness. Through his books, seminars, and international speaking engagements, he simplifies the financial planning process. Before I turn it over to Mac, don't forget we'll be hosting a question and answer session next Wednesday, September 13th at the same time. You are automatically registered for that session. And during that session, Mac will be answering any questions you may have from today's presentations. So any questions that you have, you can type into that Q&A section, but we also wanted to give you some time to think about what is discussed today, talk with your family and friends about what you may want to consider regarding today's topics. And then next week, you can come to that session prepared and ready to have your questions answered. Sorry about that. And don't forget, for future financial wellness webinars, Mac will be covering government services such as Social Security and Medicare, long-term care planning, estate planning, elder care and senior living, and more. So be on the lookout for communications around those. If you haven't registered for some of those yet, feel free to register for those in advance. And with that, I will turn it over to Mac to get us started. So thank you again, Mac.
Joe, thank you. Thank you. Thank you, everyone, for carving some time out of your day to spend with us. And thank you to the entire United Health crew. You all are doing amazing things. A little bit of background as I share my screen here. When Joe and I first got connected and he saw me speak, we were really, really energized about the fact that financial wellness ties in so much with our physical wellness. And we sat down and he told me about what him and his team are doing and some of really cutting edge programming that's being developed by United Healthcare. So thank you all for spending some time. Joe, again, want to thank you and your team for bringing this whole session together. As Joe mentioned, this is going to be a 5-part series. All right. Today, we're going to be focusing on retirement income readiness, right? And really looking at and discussing helpful tips, helpful tools for planning to and through retirement. All right. Very important that we see that it's not just to retirement, but through retirement, because the retirement phase is changing. The retirement industry is changing. So many different tools are impacting how we go through retirement and how we get through it successfully. So Joe mentioned, my name is Mac Gardner. I am a certified financial planner, blessed to have served in the industry for 20 plus years. All right. I am the author of 2 books. The first, as mentioned, Motivate Your Money, which is what this format is based on. That's a book I wrote for adults. I also wrote a second book titled Motivate Your Money, which is a book I wrote for children. I am very passionate about financial education, financial literacy, and financial wellness, and the need to have more of it in our society and our communities. Again, we're going to be having a 5-part series, as Joe mentioned: retirement income planning, government services planning, Social Security and Medicare, long-term care, estate, and elder care. So we're going to have this over a 5-month period. I wanted to read this to you here. This is a little disclaimer, Joe, and I think the team at United wanted me to read this to everyone here so we can be on the same field when it comes to the information that we're sharing today. So this planning session is made available to you from a third party through United Healthcare Group Medicare Advantage Insurance Plan. This presenter is not an employee of a United Healthcare company. United Healthcare is not responsible for the planning sessions or information provided by these third parties. The information provided during the planning session is for educational purposes only and is not a substitute for the advice of a licensed professional of your choosing. So I just want to make it very clear, we're going to be talking about financial education and wellness here. If you are working with an advisor, if you're working with a CPA, if you're working with a CFP, if you're working with an attorney, please continue to do so. I am a huge advocate of the fact that you can't get too much information. When it comes to information, I'd rather have it and not need it than need it and not have it. So what we are looking to do with this 5-part series is for me to bring the experience that I've had over 20 years working with people that are getting to or through retirement, and really providing insight, knowledge, guidance, so that when you are working with that professional, you can have a little bit more information readily available to you to have engaging conversations when it comes to your money and it comes to your personal finances. So a little bit about me. Again, 20 years in the business. I've presented over 4,000 financial plans over my career. And what that means is that I've seen a lot of different situations or instances where people are in different aspects of different phases of their life and are looking for guidance. And again, been very blessed when it comes to banking, investments, insurance, estate planning, tax management, to be able to give that guidance so people can reach their goals, be it during life or passing on assets to their heirs. Been blessed to have been recognized by companies such as Investment News, as well as Think Advisor, for the work that I do and my team does when it comes to providing financial literacy, providing financial wellness resources. And again, my 2 books, Motivate Your Money and The 4 Money Bears. And I also have a company that we started called Finlit Tech, stands for Financial Literacy Technology, and we're working to build a bridge between financial literacy and financial technology. So a little bit about me, a little bit about the work that I do and the work that my team does to really help bring more financial education to the forefront. All right. Before we get too deep into retirement income planning, I wanted to level set and just share with you a thought process of a financial planning life cycle. Right? When we start our financial planning lives is typically when we earn our first dollar. And as you see there, we start off in this asset accumulation phase of life, right? Think back to when you got your first job. Think back to when you started saving for things, investing, and utilizing your money to accumulate and grow for you. At some point in time in your life, that methodology changes and it goes from asset accumulation to asset preservation, right? You may be building money in a retirement account. You may be utilizing your money in different areas. And instead of looking for it to grow, you're maybe looking for it to not go away. All right. So that's what we call the asset preservation phase of life, right, of our financial plan life cycle. That then leads to what we call the distribution during life phase. All right. And this is when we're looking at our assets, our liabilities, our income, our expenditures. And we're now looking to pivot from working, saving, and having our money grow to making those assets generate income, right? We're looking at our retirement accounts, we're looking at our bank accounts, we're looking at all the various assets, and we say, okay, how do we make these assets generated income that can last my or our entire lifetime? Then from that distribution during life phase, we get to the distribution at death. And that's when we're talking about estate planning. That's when we're talking about probate. That's when we're talking about different ways, tools, methodologies, mindsets to pass assets that we have built up during our life to the next generation. So to start off, because this is the first session and the sessions that are going to be coming up through this, wanted to level set and just explain to everyone this idea or concept of a financial planning life cycle, and understanding where you are in this cycle, understanding where other family members that are close to you may be in this life cycle, so that those goals may be in line, and our goals and the tools that we have are doing what needs to be done for that respective phase. All right. One of my favorite analogies when it comes to retirement income planning is the picture that you see here. Now, for those of you who are avid mountain climbers, that is one of the peaks of the Himalayas. It's actually Ama Dablam. And what I love about this picture, outside of its beauty and outside of, you know, those who are mountain climbers and enjoy taking on challenges, is when looking at retirement, right, we can correlate that to a mountain climb. Ask yourself, in the mountain climbing process, which is more important, reaching the peak or getting back down? All right. And climbing the mountain is navigating that journey to retirement, right? However, getting through retirement is making your way back down that mountain, which for most parts and most people, if you ask them, that's probably more important, right? So though we understand that we need to do certain things to get to retirement, we need to save, we need to have certain assets in place, we need to have certain things in place to provide us a nest egg or the certain tools or resources. Through retirement, right, the trek back down the mountain is just as, if not more important. And for a lot of people, that can be challenging, right? Because we all go through life and we know that we have to work and do all these different things, but there's no manual for retirement income planning. There's no manual for retirement. Retirement is different for different people. So as we look at the mountain, utilize, or I like the analogy again of mountain climbing. It's not just a journey to the top, it's the journey back down, which can be as important, if not more important, than getting to the top of the mountain peak. All right. You're going to hear a consistent messaging throughout all 5 of these sessions, right? And that's the comparison between physical fitness and financial fitness, all right? I am a big advocate of the fact that your human body can go through life, and we can take care of that to make sure that our bodies last. We can do very similar things with our financial bodies. And so it's important that we have financial fitness to and through retirement. And when I talk about financial fitness, I talk about getting an understanding of where we are today. Just like when you go into the doctor's office and you sit down and he checks your heart, or she'll check your blood pressure, she'll get a baseline, right, of your overall physical health. In order to get a baseline of your overall financial fitness, there are few things that we need to have an understanding of. All right. First, your balance sheet. And by balance sheet, we talk about assets and liabilities. Assets, of course, are things that we own. Liabilities are things that we owe. Okay. So that's the first step or baseline for your financial fitness during retirement. Literally sitting down and writing on a piece of paper, these are the things we own. These are the things we owe. All right. The next step after that is your cash flow, right? Income, expenses. Now, depending on what phase of retirement you're in, we'll talk a little bit more about this further on in the presentation. Your income earlier in retirement may be a certain amount, but your expenses may potentially be higher because you're just getting in. But understanding your cash flow as you're entering retirement, or even as you're going through retirement, is key, because your cash flow is your personal financial blood flow, right? So think about it that way. Your balance sheet are your bones and your muscles. Your cash flow is the blood flow that is the lifeblood of your financial body, right? The third aspect of your financial fitness isn't necessarily dealing with money. It's those things that are intangible. Your family, your friends, your community, right? Those are all very important aspects of your life once you're in this phase. Who is going to be there to provide, love, caring, who's there to help you when you need assistance. So there's so many other different factors that go into financial fitness, but this is the baseline. And for those of you who are on here who may not be working with an advisor, this is probably one of the first steps that we want to take, is looking at your assets, liabilities, income, expenses, and then looking at your family, friends, and community to see how all those things work together to get you through retirement. All right. I want to spend a little bit of time on the balance sheet, because these assets make up your overall retirement income plan. Okay. So when we look at assets, assets come in two forms. There's real assets, your home, an automobile, land or property that you may own, furniture, collectibles, right? Then there are liquid assets. And so there will be your bank accounts, your IRAs, things along those lines, all right? The next side would be your liabilities. So short term is technically anything that takes less than a year to pay off. So those could be credit cards or personal loans. And then long term would be things like a mortgage or an auto loan, right? So understanding your balance sheet is going to be important as you're navigating retirement income planning, because those assets are tools that you can use to generate income on the liquid side. But your real assets can also be tools that can generate an income for you. All right. Things like reverse mortgages, things like utilizing your automobile to generate income. So there's lots of different ways to tap into assets that can provide income during retirement. And then liabilities is a side. A lot of times when I work with folks and I do financial plans, a lot of times people want to keep those long-term liabilities as low as possible, and will look to maybe pay off a home mortgage or look to keep credit card payments low so that your cash flow remains strong. All right. So again, the personal balance sheet is sitting down, looking at your assets, looking at your liabilities, but then breaking them down and looking at what are real assets, what are liquid assets, what are short-term liabilities, and what are long-term liabilities. Okay. Retirement income or retirement planning is changing, and it's changing in a very big way. A lot of the reasons why I structure this presentation the way I do, and we talk about what your balance sheet looks like, what your income statement looks like, and all these different factors, is because retirement income has changed dramatically over the past few years. And this is what I mean. Here, we're looking at then versus now, all right? 30, 40 years ago, retirement income planning was a combination pretty much of three things. You worked for a company for a long time, and when you stopped working for them, they provided you a pension. Social Security, a lot of folks may not be aware, but Social Security was created to only replace 40% of your overall income. It wasn't created to replace everything. It was pretty much there to be a safety net uh, for our population. And the third leg of that stool, all right, was whatever savings you could put away to be able to fund retirement. Those days have changed. Some of you on this call right now, on this webinar, may be fortunate to be receiving a pension, but a lot of corporations have stopped pensions altogether. And because that pension aspect of retirement income planning has gotten so much smaller, it is now putting the responsibility on us as individuals to create the tools and fund the assets needed to maintain our lifestyle during retirement. So many of you out there may have heard of a 401k or a 403b or a 457 or one of these 401a new types of retirement plans. Those are called those are accounts that allow you to put money. They're called technically defined contribution plans. That was the phrase I was looking for. Whereas a pension is a defined benefit plan, right? So with a defined contribution plan, you are on the hook in three very important ways, okay? Number one, you have to determine or get help from someone who can tell you, how much do I need to save on a regular basis to have enough money to retire? That's question one. Question two, how do I manage that investment account? Stocks, bonds, cash, international, large cap, mid cap, small cap, all these tons of options that are available to you, right? But how do you go through and manage those assets? And then here's the third question. If you're fortunate to have guidance or know how much to put away, and if you're fortunate to have been able to manage this asset all the way through to retirement, the third question is, how do you then turn this account, this investment asset, into an income stream that you cannot outlive? Right? So those are three very important questions and three very important aspects of retirement income planning that now fall on individuals for the most part as we're going through retirement. Right? Social Security is there for now, but we hear rumblings in government about what's going on with Social Security and how much longer it can last. And then savings is the other option. So the face of retirement income is changing. It has changed dramatically over decades. And so that is why it's so important for folks to be able to understand what it is that they are responsible for, and then having that help from resources to be able to manage that process, because you could be working for 20, 30 years and you could theoretically be in retirement for just as long. All right, as we're looking at retirement, all right, and we're looking at this big picture, one of the big challenges a lot of folks have with retirement income planning is budgeting. All right, I can't tell you how many times I've sat with folks and we're looking at a retirement plan, and we're looking at the next few years before retirement and what retirement's going to look like in the early years, and we're trying to really find out what's that number, right? What's that actual number that we need, net of taxes, because it's still a very important aspect of it. And so one of the things that we like to do is we like to look at what we call a needs pyramid when putting this budget together. All right. So those needs at the bottom of the pyramid are food, clothes, shelter, medicine, healthcare, those things, those aspects that we're going to need on a regular basis to maintain our lifestyle. And then find out what the cost for that aspect of your life will be. Then we can segment the wants, and that could be travel, eating out, gifting to family, vacation. But in doing that and segmenting the costs of these different goals, expectations, desires, right? It makes it easier for both yourself and an advisor that you're working with to provide you that guidance and give you realistic expectations of what your budget should be, could be, and what is your probability of success long term. All right. Should this be a budget that you work with over the next 5, 10, 15, 20 years of retirement? And of course, wishes are things that, if the money's there, buy an RV, a vacation home, international living. I hear folks now can live on yachts for pretty much all of their lives, which is pretty fascinating. Giving to others or legacy planning, giving to your church, giving to charities, giving to children, what I call the cha-cha-cha list. These are all very, very important parts of the retirement income plan, but it's a key part of budgeting and sitting down either with your spouse, sitting down with your family, and as you're either entering into retirement or even in retirement, just level setting what your needs, what your wants, what your wishes are, and then making sure that your retirement income is aligning nicely with those three aspects. One of the big aspects of big areas of retirement income planning is getting a very good, a thorough understanding, I should say, of what type of investment assets you own, right? And then understanding the taxes and how taxes are impacted by the various assets you own. Now, again, don't want to get very deep into this segment of this slide, but definitely wanted to talk about the three buckets of assets, the three asset types, right? And give everyone on the call, on the meeting, just an overview of how these assets work from a tax perspective, so that when you're planning your retirement income, you have a better understanding and you don't have any surprises when you're looking to tap into these various buckets to fund your retirement income plan. So that first box you see, it says taxable. So when we talk about taxable assets, we look at things like your bank accounts, your checking, your savings, your CDs, brokerage accounts, money market. Those are financial assets that at the end of the year, you're going to get some sort of 1099 from an institution, a bank, the brokerage account, that says these dividends were paid. So if you've got a CD and they're paying you 2, 3, 4%, you're going to pay taxes on what comes out of that or the earnings of that CD. Okay. The next bucket over are what we call tax deferred accounts. These have become very popular within the last 30 to 40 years. All right. The 401k account actually was created in the 1970s. So an IRA, an individual retirement account, 401k, which is used by many corporations as that defined contribution account where you get to put money in, the company may match money. All right. 403bs, a lot of times used by educational institutions or by non-for-profits. A TSA, which is a tax sheltered annuity. All right. Pensions, these annuity types of constructs. Now, what makes these investable assets or these accounts special is when you put the money into these accounts, your taxes are deferred, meaning you don't get any 1099 or you don't get anything from these institutions as long as the money is kept in that account. When you do pay the taxes on these tax deferred accounts is when you start taking money out. And if you take money out of these accounts, typically before 59 and a half, there are penalties, typically it's 10%, and then you'll have to pay taxes on everything that came out with a 401k because you got a tax deduction in. That's how the IRS looks at it. So you have taxable accounts, you have tax deferred accounts, Then you have what are called tax-free accounts. And those would be Roth IRAs, Roth 401ks, municipal bonds, or even life insurance. What makes those investment assets or financial assets so unique is that you can get a benefit of not having to pay taxes while it's growing, as with the Roth IRA or the Roth 401k. And then you can get that money out income tax free when you're retired. Municipal bonds, similar. You don't get any tax deferred growth on the municipal bonds, but typically they are state and federal income tax free. And you don't have to pay money on the dividends that come out. Life insurance is a very unique creature as well. With life insurance, you put your premiums in, it grows tax deferred, and you can take income out of a life insurance policy, right, in the form of a loan, and that is income tax free. So it's very important when you're either sitting with a financial advisor, sitting with a CFP, sitting with an accountant, sitting with someone that you know, you like, you trust about your financial assets. It's important to understand the tax ramifications of utilizing all of these assets once you're ready to utilize them for retirement, because the taxation is going to be different. Something I didn't mention about those taxable assets. So because those bank accounts, CDs, brokerage accounts, because you already pay taxes on that money that you've dropped in, you only pay tax on the growth. So if you ever need your money back, you don't have to pay taxes on that money again, right? So understanding income taxes in retirement is very important. Again, please consult your tax advisor, tax attorney, financial advisor, or certified financial planner when looking for more detailed information about these types of accounts, all right? But understanding how the taxes work with these is very important. The last thing you want to do is you get into a point where you may have an IRA or 401k and you cash that out, and it's a big tax liability because you never sat down, you spoke with a consultant about what those tax ramifications can be or would be if you make a big move that way. All right. Live on versus leave on. All right. This is a slide that I could spend a lot of time on because the financial planning process can be very powerful. Again, being in the business for as many years as I have, engaging and working with so many people as I have to provide financial plans, a lot of times folks are working through life, getting to retirement, in retirement, and they just have this sneaking suspicion, and they really don't know if they have enough. They may think they have enough. They may do some rough math and no, man, we may be right. But one of the benefits of working with an advisor and working with a planner and having a financial plan done is it answers some questions. It allows you to understand, do we have live on money or do we have leave on money? And here's what I mean. If you've been working and you saved a certain amount of money and you're in retirement now, and you're looking at your balance sheet and you're looking at your assets, your liabilities, you're looking at all that stuff, you may want to know, hey, what's my probability of success? What's our probability of success if we consistently spend X amount of money over time during retirement? A financial plan, there's software out there that allows us to understand that, and it's called Monte Carlo simulation. And what it does is it sits down and it takes and looks at all these different rates of return, different rates of volatility in the stock market. It looks at all these inflation, looks at all these different factors, and it can provide folks a guide as to, hey, you know what? Based upon what you have, how much you spend, and based upon these different factors, you not only have enough money to live on for the rest of your life and your spouse's life, you actually have sufficient money to leave on to the next generation, right? So that's why I am a huge fan of the financial planning process. I like to say that all financial planning is bringing the future into the present to do something about it today, right? So if you do have an opportunity to find a good financial planner or someone that you know, you like, you trust, no matter whether you're in the retirement accumulation phase or you're in the distribution during life phase, this is a great process for you to be able to sit down with a professional, share your current situation, assets, liabilities, income, expenses, family picture, have a financial plan done and completed, and then find out for yourself if you're on track to reach your goals. You may be surprised to find out that, hey, you know, you not only have enough money to live on, you have money to leave on to the next generation. And then you have other discussions and other different tools to be able to get those assets on to the next generation in a tax efficient manner. So live on versus leave on. Again, I'll keep repeating this. The financial planning process can be very beneficial. Please, 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 if you haven't done so already, find a trusted advisor in your area and work with them and let them know that you'd like to have a financial plan to get a good idea as to your probability of reaching your goals. Great financial planning software that's out there that can assist. All right, so we've talked about all the different things that we need to do sort of on the front end, all right? Taking a look at our finances, looking at our balance sheet, looking at our income statement, understanding family dynamics, understanding, why having a plan is important. What I want to utilize the rest of our presentation, our time together on today, is we talked about going up the mountain and why going up the mountain, has its challenges and the 3 questions that you have to ask yourself, how much do I need to save? How do I manage the asset? And how do I generate the income, right? But what I'd like to do now is to sit with everyone here and talk about 5 very important challenges to the trip down the mountain, all right, which is the retirement distribution phase. And these are 5 areas that you must contend with when you are in the retirement income phase. There's no maybe could, if you are fortunate and blessed to make it through retirement and have a healthy one and spend time with family and reach the goals that you want, you're going to have to contend with these 5 things. So it's very important that when you're working with an advisor, you're working with a trusted person to manage your money, that your retirement distribution plan addresses these 5 areas: market volatility, inflation, taxes, healthcare cost, and longevity. All right. And we're going to go into each one of these and talk about them and then really address how they can be mitigated and how they can be dealt with in your overall retirement income plan. All right. This is a chart of the S&P 500. So for those of you who are investors, you will know that the S&P stands for Standard & Poor's. These are the 500 largest companies in the United States. All right. S&P was started in the late 20s, 1920s. What this chart is showing us is that blue line from when it started all the way to, a few years ago, it's going up. If you were to draw a straight line from where it started to where we are today, it's up. But those gray bars that you're seeing are substantial drops in the market. All right. Now, we have zero control over the stock market. I like to joke around with clients and folks that I work with to say we can control two things in our lives: our asset allocation, whether we have our money in a coffee can in the backyard or we have it all in Forex and Bitcoin, and the cost of the investment solution that we're utilizing. Those are the only thing we control. We cannot control anything else. Why this is important is if you are in what's called the damage decade, right? The damage decade is your first 5 years prior to retirement and your first 5 years in retirement. If you have or experience any major market volatility in your portfolio during that damage decade, it can substantially sidetrack your financial plan. For those of you who had money invested in 2008, 2001, 1984, I was an advisor in 2008 and 2001, not 84. But I had clients who did have money invested those times, and you had a major hit to your portfolio, right? It's going to be tough to get back from a hard loss. So that's why it's important to understand the market and understand that what portions of your assets need to be invested in the market when you are in the retirement phase of your life. Longevity. This is another big one. The life expectancy in the United States, 1920 versus 2020. All right. As of the most recent figures that we're looking at,